Now, thanks everyone for joining us today. This is our Savvy IRA planning. It's a little bit of a misnomer. It says for boomers. That's the title of the presentation. I think it applies to boomers and Gen Xers at this point, and even millennials at this point, because the planning for IRAs really should start well before you retire. And that's one of the things that a lot of people kind of fall into what I would just call a tax trap, which is they stuff money in their 401k or their 457 or their 403b at work forever, forever, forever. They make their contributions to their IRAs and they just let it grow, which is great. The problem is when they get to retirement age and beyond, now they've set themselves up for a very, very, I would say, high tax bracket that they wouldn't necessarily have to be in if they had just done some planning ahead of time. So I'm Matt Donaghue. I'll be the host for today's call. So I'll be, prompting a lot of the Q&A between Jason and Ken. A lot of you know Kenneth Hamilton. Kenneth Hamilton is the guy who knows more about pension and retirement planning than probably anybody on the team. So he can really get into the weeds on, hey, your pension, your Social Security, your IRA, here's the things you need to be watching out for.
Mhm.
Jason is the tax expert on the team. So when you hear me ask tax questions a lot, Jason is our guy when it comes to tax planning. We were kind of giving him a hard time yesterday about how, it's too bad he's not a CPA and instead is a CFP because he ends up teaching a lot of CPAs about the strategies we're putting in place. So it's always interesting, right? And then there's me, your host. I really just enjoy talking about this stuff. And, you know, I just think it's super interesting.
Don't be so humble, Matt. You're an expert in risk management and digging down into other problems. Like,
Yeah,
come on.
absolutely. Okay,
Yeah,
fair enough. Fair enough.
exactly.
Just trying to be modest. Just trying to be modest. Okay, so bunch of questions we have here, and I'm not going to read through them all, but you can see the questions that a lot of people ask, right? If I'm going to make contributions, what is that really? What does that mean? How do I get taxed? What happens when I die? As tax law changes, what's going to happen to my IRAs and my distributions and all that? So those are some of the questions we're going to get through today. Um, the landscape that everybody on this call is dealing with is way different than I would say Jason's and my parents and older. So when I say that, I'm talking about people in their 80s and beyond. They had a very different experience in many cases than most of us will. Pensions used to be way more prevalent than what they are today. Social Security, yeah, it's changed a little bit, right? And they probably did some savings as well, but it was a very different environment when they were working in the 50s, 60s, and 70s as opposed to working in the 70s, 80s, 90s, and beyond. And the thing that made that change was about 1980 when 401ks came out. And Jason and I were just talking about this with someone this morning. The investment world, the retirement world, the tax world completely changed when 401ks came out. I don't really believe anybody thought companies would migrate to 401k, 457, 450, 403bs as fast as they did. I also don't think the people who wrote this into the tax code realized how many people would actually invest. And so even when you see the market go down in the post 19, I would call it the post 1980 world, you have to remember that, hey, even if there's 20% unemployment, you've still got 30, 40, 50% of the public who's working and is contributing to these types of plans. And the reason that's so important is when they go to retire, a lot of times people are going to shift these to an IRA. So they're going to do what's called a rollover. Now, the question a lot of people are going to have is, how long am I going to live? And we talk about this all the time with people. You can see some of the mortality numbers on this page in front of you. Um, Folks, the one thing I'd say is don't overestimate the impact of your parents or your grandparents on your longevity. Mayo Clinic, a bunch of other places have done loads of studies on aging. Your genetics only make up about 25% of the factors that'll dictate how long you live. The rest of it, believe it or not, is your lifestyle. Do you take care of yourself? Do you exercise? Do you try to eat right? Do you try to do those things? If you do those things, you have a much better chance of living, even with a long life, even if you have maybe not the best genetics overall. So don't peg yourself to your parents one way or the other. right? The one thing I will say, and Jason and Ken have heard me say this a lot over the years, is when you're thinking about retiring, when you're thinking about using your IRAs, the prudent person plans on living a long time. And if you do that, the worst case scenario is you die with a couple extra bucks in your pocket. That's the worst case scenario. It's not a bad worst case scenario. So, all right, guys. So let's talk a little bit about, when people start getting in their, I would say probably 50s and beyond, um, the landscape starts to shift, right? Jason and Ken, give us some insight on how the landscape starts shifting as people see their kids start to get a little older, house starts getting paid off, things like that.
Well, the first one is that house payment goes away. And whether it was 1,000 a month because you bought it a long time ago, or it's now 3,000 a month because maybe you've upgraded since then, these dollars now can really be deployed. The other thing to be thinking
Oops,
about,
sorry.
the other thing to be thinking about is the empty nest. Man, I got a 3-year-old, as most of y'all know, and from daycare to food to clothes and all these things, hopefully at that point your kids are financially independent and these dollars can be redeployed for yourself. Um, and if you're 55 and you're wanting to retire at 65, that's really exciting. The scary thing is that's only 120 bill cycles that you have left. And you are officially in the descent and you are in the clouds. And so you gotta really be thinking about looking at all the dials on the cockpit dashboard and make sure you're going to land it right. Because the opportunities for things to go wrong are increasing and the margin for error is only getting more so. But yeah, Jason, what are some of the things you see as
I love Ken's cockpit analogies, plane analogies. They're great. The things that I see from the planning end is the change in tax situation, right? You used to having a big tax return. You got kids on there. You got some of those deductions that you get to get, some of those special savings that you get to get through the 529 plans or whatever you're doing for college, mortgage interest, all those things. All those things are coming off. So now you're at a position where you have to look into other tax benefits like, hey, I can do catch ups on my retirement plans. Hey, I can do extra funding. Hey, I can do maybe finding some expenses that become medical expense deductions from that end. Because as we age, we get into more medical situations. So you have to really think about that change in life in that phase and it affects your tax return, and then also how you're going to shelter still. It's not just about how much money you make, it's about how much you get to keep.
Yeah, and that doesn't stop when you die either, does it?
No, gets
Right. So,
worse.
yeah, we'll talk about that too. Um, so some of the basics on the traditional IRAs, right? Tax deductions, tax deferral. Just remember traditional IRAs, when that money comes out, it's taxable as ordinary income. Okay. Ordinary income. Also, if you are taking money out before 59 and a half, you're also looking at a 10% early withdrawal penalty added to the income tax that you take out. Um, they do have contribution limits. The biggest thing I'd say with this, we get questions, especially from people who are working in retirement, is can I continue contributing? As long as you have earned income, you can contribute. And you can contribute not just for yourself, but also for your spouse, even if your spouse doesn't have earned income. So as long as you have earned income, you can continue to contribute. Apparently, I can't say that fast, um, but there's no age limit on it. So if you're one of these people that you're just going to work and you're going to die with your boots on at some point, you want to keep contributing, you knock yourself out. You keep doing it. So how do I get a deduction for IRAs, for IRA contributions? You got to stay under certain thresholds. And essentially, are you participating in a plan at work? Now, I'm going to throw this one over to Jason. Do we get people tripped up on this every now and then, Jason? Like, why didn't I get the deduction? That
Oh,
kind of
yeah,
thing. Yeah. So talk
definitely.
to us a little bit about that.
Yeah, so when you're looking at this, you really have to consider your employer sponsored retirement plan because if you're in one, then you're not going to be able to take that deduction, especially if your income is at a certain levels, and those levels get updated annually from that part. Um, But there's always if you don't have any other IRAs outstanding, you can always take non-deductible money, put in an IRA. And if you don't have other IRAs, then you can just convert it to a Roth. And that makes it even better in regards to being able to build up faster tax-free assets.
So from that standpoint, how many people know those rules?
I'd say less than 10%.
Yeah, it's pretty minimal, right? So that's one of the things you want to talk to a financial planner about that, because that's part of our job is to make sure we know the rules. All right, Ken, you want to talk about Roths?
Absolutely. So I imagine if you're on this call or listening to it, you've at least heard the term Roth before. But let's go ahead and level set, make sure we're talking about the same thing. Is these are after-tax dollars that have grown tax deferred, so you don't pay taxes when they grow. And if you take a distribution from it and you can check all the qualifying boxes, you get all of those dollars completely income tax free. And that's really, really valuable. So let's just quickly run some numbers. If you contribute $5,000 when you're 30, and that 5,000 grows to 50,000, so 5,000 to 50,000, and now you're 59 and a half, your full retirement age. Well, if it was in a traditional IRA, that $50,000 liquidation is fully taxed as income. And 15, 20, 30 years from now, do you know what the tax brackets are going to be? What the standard deduction is going to be, if you know what your effective tax is going to be? No, if it's today, you're going to probably be somewhere around 15% upwards to 30% is what you're going to need to pay on that liquidation on that 50,000. Where if it was the Roth, you would have paid today's tax rate on $5,000. So we'll call it 20%. So $1,000 in taxes to get 5,000 into a Roth. That same 5,000 would have grown to the exact same 50,000 if it were invested the same. But when I take out that 50,000, all of it's income tax free. So if you had a choice, do you want to pay, call it 20% on 50,000 or 20% on 5,000 and you get $50,000 income tax free? I know which
Yeah.
I'd pick.
Yeah, Ken, you use this expression, seed and harvest, right?
Yeah,
And would you rather pay taxes on the seed or the harvest?
absolutely. And when thinking about this, as you're getting closer to retirement, it's really important. I talked about the cockpit and the dials, is think about where your assets are. How much of your assets are in the tax deferred bucket, in the taxable bucket, like your brokerage, checking, savings, and real estate? And then how much of your dollars are in the Roth, the tax-free bucket? Is that where you want it to be? Is that where you always want the levels to be? And so be thinking about that as well.
Um, so Jason and Ken, I'll throw this out to you. A lot of people who want to do Roth, right? They make too much money. And a lot of times they come back from looking at charts and stuff like that, and they're like, oh, my income's too high. I can't do it. This presentation doesn't really get into it, but do you guys think you could take a minute and talk about the backdoor Roth contribution process? Because a lot of people just don't know they can do that.
Yeah, I mean the backdoor Roth is, we'll see how long they keep it around. But
Right?
it seems like everything is good. They start taking it away.
Right.
But so the backdoor Roth is for people that don't have IRAs. We have a client that does this right now. Is a high earning executive with a major oil company, has a spouse that's also an executive. They only have an IRA for one function, and that's to put the non-deductible contribution in, just like we're showing up here, the 8,000 if you're 50 or older, right? And immediately convert that 8,000 into their Roth account. And every year they do it over and over and over again, because the majority of their assets, like most Americans, are held at the employer retirement plan that they're at. They've got plenty of money in those plans, Roth and non-Roth in those plans. But this helps them get that Roth IRA built up over time without causing a taxable event. Because when you convert a non-deductible IRA into that Roth, there's no tax to be had unless you had earnings or interest paid. There's nothing for them to tax.
So one of us on this call, me, that's what I do every year. Every December, I sit down, I make my non-deductible Roth or IRA contribution, and I immediately convert it into a Roth IRA every year. And Jason's absolutely right. I never get a tax bill for that. I'm paying the taxes anyways because it's a non-deductible contribution. Why wouldn't I immediately convert it and make sure it's all going to be tax-free later on when I want to take it out?
Because if you really want to ruin a Saturday night weekend, is keeping a non-deductible traditional IRA and then figuring out the taxes on your retirement situation for the rest of your
Yeah.
life because of it. The
Yeah.
last account you ever want to hold on to is a non-deductible traditional IRA. It is a tax nightmare, just full
Yes.
disclosure. So, uh,
Absolutely.
yeah.
Absolutely. Okay, we mentioned this earlier. You got to have earned income. If you have earned income, your spouse can contribute as well, right? And guys, can you still hear me? I just heard a beep on
Mhm.
my. Okay, good. Okay.
No.
All right. The other thing is this gets into tax deferral, right? So we run into this situation every now and then with people as well. You can see here, this is a 30-year timeline. A lot of people look at these charts and they're like, well, I'm not 25, so that doesn't really apply to me anymore. The thing I would say is if you're 55 or 65 and you're at all concerned about longevity, you absolutely need to be moving money. Did I lose you guys?
No,
Oh,
you're
you're
Nope.
still
good.
good. Okay, good. Yeah, I keep hearing a beep in my headset for some reason. Um, but if I'm 55 or 60 or even 65 and I'm at all concerned about longevity, doing those backdoor Roth conversions, getting money into Roth accounts that you're just not going to spend till much later in life can mean a lot of extra tax-free money for you later on. So when you see these types of charts, don't fall into the thinking of, oh, I'm not 25 anymore. That doesn't really apply to me. If you're 55, 60, or 65, this absolutely still applies to you. All right, employer sponsored plans. One of the credentials I hold is in professional plan consultant. I know Jason has a similar credential, in terms of tearing qualified plans apart. Basically, the difference here is this is what's called an employer sponsored plan. So this is like your 401k, right? Where Ken's expertise is more in the pension side, which is what's called a defined benefit plan, right? So this is defined contribution plan, okay? So what you want to look at is how much can you put into those plans? More importantly, I'd say rather than taking you through each one of these, three key points, is there's been a significant increase in the amount of plan sponsors who have Roth options for 401k, 403b, 457. You should absolutely be taking advantage of those if you have that available to you. My wife has that at her work. She maxes out the Roth 401k option. And Jason, you might know this better than anyone. Ken, you might know it, but I believe legislation was passed this year where um, company matches can now be made into the Roth as well. Is that correct, or is that still pending?
It is correct, but the employer has to opt into it, which
There
much
you
like while
go.
the Roth was technically available from like 2011, the
Mm-hmm.
Roth 401k, we didn't start seeing it adopted until like 2016, 2017. But now this might be also fact is every 401k now has a Roth option. Is that required now, Jason?
It is required.
Okay.
There you
So
go. So you can take advantage of this Roth and look at the limits you can put in on the bottom part of the screen there, right? 23,500, 31 to 50 or older. Um, and then there's an additional, 11,000 or so. Well, not quite, an extra 4 or 5,000 you can do between the ages of 60 and 63. So as you start to get older, and going back to what Ken talked about earlier, and Jason talked about, kids are out of the house, the mortgage payment is maybe going away, or it's a small part of your income now. You've got the ability to pad these accounts through your employer plan. And if they don't offer it, ask for it. Ask for it. That's the only way they're going to know that somebody wants it, is if you raise your hand and say, hey, I'd like to have this. Okay, you get to retirement age. You're done. The 401k is still sitting there. You've got essentially six different things you can do with it, right? Um, Jason and Ken, what would you say are the top two or three that people end up doing out of these six, and why?
I'd say number one is definitely one of the top ones, and it's just because they don't know what they can do, and life catches up with them, and they just don't take action on what's available to them in the market space. So they just stick with what the employer has and ride it out.
Ken?
Yeah, I completely agree, which as long as it's invested well, properly diversified, is not a bad option, especially in your 40s or 50s. But within that 401k, there's limited options. Within an IRA, there's all of the options. So ask yourself, which would you have rather have access to? Again, the other one is I always used to joke, okay, so you left your job, you took your picture, you took your trophy, you took all these things from your office, right? Why did you leave your wallet with the most dollar amounts you have? Why did you leave it there at the office? Well, okay, this is where it goes into an IRA and you keep it in house. But yeah, 1 and 2 are the most common.
Yep.
There you go. Okay, so taxation. You get it. You all see these charts, right? And this does not include state. I know we got a bunch of people from California on today's call. So the California chart is, or California state income tax is on top of this. Okay. This is just the federal. So when you're looking at it, the one thing I want everyone to remember about the US federal tax system is it is what's called a progressive system. Okay. So your first, and I'm going to focus on the married joint on the right-hand side, your first $23,850 of income is taxed at 10%. The monies between 23,851 and 96,950 is taxed at 12%, and so on and so on and so on. So this will become important later when we talk about Roth conversions, because a lot of times people get hung up on, well, I'm going to be in a higher tax bracket because I did a Roth conversion. Well, okay, that's true, but that also doesn't mean that all your income is now taxed at 24, 32, 35, 37%. It's just the dollars that are in that bracket that get taxed at that level. I will stress something Ken said earlier, one of the expressions Ken uses a lot, which is, would you rather pay taxes on the seed, the $5,000 that Ken used in his example, or the harvest, the 50,000 that Ken used in his example? I don't know about everybody else on the call. I would rather pay taxes on $5,000 if I have the choice. Even if it means I pay a higher number, I'd still rather pay it on the 5. Okay, tax rates. As everybody knows who knows me, I am a huge history guy. I love the history of the markets. I love the history of taxation. I just, history is my thing. The biggest thing I'll say is when you look at marginal tax rates, okay, the top marginal tax rate as recently as the mid 80s was 50%. Going back to 98, mid 90s, right? We've hovered right around the 40 to 30 to 40% range for the top marginal bracket. As you can see, that is an anomaly since the income tax went into effect back in the 1910s. Okay. The only time you have seen income tax rates be that low was the roaring 20s. That's the only time you see it be that low. The second thing I'll add to that is when you look at debt at the federal level, which I know is a big, big thing that everybody's talking about today, and it's a big, big number. Debt at the federal level, adjusted for inflation back in 1987 when the rates got dropped, was the equivalent of $4 trillion in today's number. Today, federal debt is what, at the $34 trillion number and climbing. So, regardless of what's going on in politics today, regardless of how people feel about politics today, the numbers just don't add up. Eventually, something is going to have to change at the federal level. The reason I bring that up is if you're going to do Roth conversions, if you're going to fund Roth accounts, I think Jason said it earlier, do it now. Because if you don't do it now, you don't know how things are going to change. We don't know how things are going to change. Get grandfathered into this stuff if you can. If you can. Okay, side effects of IRA distributions. There's a bunch of stuff that can happen. Okay, I'll hit this real quick because I know we're already at 26 after. Feels like we just got started. But so net investment income tax, that can add an extra 3.8% onto your taxes at the federal level. You can also run into a ton of phase outs that can also have the real effect of raising your tax rate. Your Medicare, your Part B and your Part D can go through the roof through something called IRMA, which is the means testing for that. Unlike the federal income tax system, the IRMA tax system is a cliff system. So whereas with the federal tax system, it's progressive, only the dollar amounts in those bands get taxed at that rate. IRMA, you go $1 over, you're in the next bracket. It's just the way it works. And it's not just you, it's you and your spouse. You both go into that next bracket. Taxable Social Security, you might be someone who's been able to keep their Social Security at 50% or even lower from a tax standpoint. Well, now you might bump up to where 85% of your Social Security is subject to federal income taxes. We'll see if the idea of no income taxes on Social Security benefits actually goes through or not, especially given $34 trillion of debt. We'll see. It can also affect, especially for those of us who are older parents, it can also affect potential for financial aid because now you've maybe phased out of some of the financial aid calculations. And then, of course, like we talked about earlier, Roth IRA contributions might no longer be an issue. I am going to ask Jason specifically about required minimum distributions. Okay. They'll kick in your early 70s. Jason, how many people who are, say, 60 years old that you've talked to really understand what's going to happen to them in 15 years with that $2, $3, $4, $5 million IRA that they have?
Almost none of them. I mean, every time we go through a planning discussion and build a comprehensive financial plan for a client, we find a lot because you were told, I don't know if you remember this, Matt, but we were told early and often, save as much as you can in your retirement plan and build it up, right? So you exit that place with $2 million, $3 million in your retirement plan, and your RMDs are through the roof. They start off at six figures and just climb from there as we age, and you get caught in this gigantic tax spiral that you can't get out of.
Yeah, and the other challenge is some people aren't even paying attention when it does hit. And so if they miss it, they get an extra 25% penalty layered on top, which then puts them in an even bigger trap because how are you going to pay the penalty? You're going to pull more money out. You're going to pay more money out, which means you paid more federal tax, and you're going to end up paying more state tax if you're in California, and you still got to pay the 25%. So, folks, when you're in your 50s, 40s, right? That is the ideal time to start planning for this. If you are in your 60s, it is not too late. If you're in your 70s, it is not too late because all you need to do is put in a strategy that's going to manage it. And that's one of the things that we actually specialize in.
Can I put on my tinfoil hat
go
real
ahead,
quick?
Ken. Go ahead.
So I'm going to put on my tinfoil hat. I don't know if it shows up on the camera.
We're going to get you one, by the way.
But that'd be great. Who do RMDs benefit? You know, this income that you may or may not want, who is it benefiting? Well, it's generating taxable revenue to help cover things like the debt and other expenses. The other thought is when are you allowed to contribute the most into your retirement accounts? Starting at age 50. Yes, it is good for those that are needing to play catch up, but a trap I've seen happen time and time again is people say, oh, I can do more, so they do more. And what then that happens is it further balloons their tax deferred bucket as opposed to balancing it out. And now the RMD problem, which might have been small because we put the dollars into the 401k or whatever it may be, now it's a bigger issue. And so be thinking about when you're in your 50s, in your 60s, if you are contributing dollars, yes, you can do more into the 401k, but is that where that dollar should go?
Right.
So just be thinking about that.
Right. The talking heads in the media, and we won't say them by name, the talking heads in the media will tell you, pound that money into that plan at work. They never talk about the taxes, ever. All right. So as a percentage wise, so here you can see this is the table that they use, and this is all public. This isn't hidden. You know, you can go to the IRS website, you can find this. But here's the number that we tend to get asked a lot is what is it really going to be? Right. Well, if I'm 73 today and I got to take an RMD, it's 3.78% of last year's account balance. So when I look at that, if I have $3 million in my IRA, 3.78 is over 100 grand. I have to pull that money out whether I need it or not. Whether I need it or not. So what do I do? We'll talk about some ways that you can manage that. In terms of mistakes people make, this I think gets more into the idea of benefits of an IRA versus benefits of a 401k. Jason, do you want to talk a little bit about aggregation and how people make mistakes like if they left money in the 401k and they think they can take it all out there. I mean, can you just, because I know you've run into this a few times in your career.
Yeah, we run into this more than I'd like to see, but aggregation it can be very confusing for people because they see the IRA and the 401k as the same structure. And yes, they may have some of the same qualities, but the service doesn't see them as the same structure. So if I have money in my 401k, I have money in my IRA, I can't just slap those together and say, hey, I can take all of the money out of my IRA, I'll be okay. The service is not gonna accept that as an appropriate response from that end. So this is where it becomes hugely important as to how do you consolidate things to make things easier from a distribution standpoint. The other thing too is what makes it even more confusing is, Matt, have you ever gotten statements from multiple custodians?
Yep.
And then when you get those statements, typically when you're in RMD mode, your required mandatory distribution mode, each of them has an RMD on it.
Yep.
Right? So while you didn't take anything out of your Fidelity, but you took something out of your Schwab, you could have taken everything you needed out of your Schwab. Fidelity doesn't know that. They're going to keep reporting that you need to take money out. So it causes a lot of chaos with clients that are trying to DIY it, if you would, from that end and run the management of all of it from that end. So aggregation is hugely important in a lot of different ways.
Yeah. That's one of the things, to your point about the 401ks, that's one of the things a lot of people don't know. If I have a 401k and I have an RMD, I've got to take the RMD amount out of that 401k, right? It's not like IRAs where I could have 3 IRAs, right?
Yeah.
I mean, if I have 3 old 401ks out there, that means I got 3 different distributions I have to do. So keep that in mind. Okay, some of the things you can do to mitigate it. One is I'm going to hold off as long as I can on taking my IRA distributions. I'm going to sound like an ESPN host for a second here. Ken and Jason, pros and cons. What are the pros and cons of this?
You get more compounding interest. You pay more in taxes. Is the con.
Yep. Yeah, there you go. There you go. All right, strategy number 2. Well, back to number 1. This just highlights exactly what Ken said. As your IRA grows, so does Uncle Sam's share. His hand is in your pocket. The state of California is in your pocket, right? They just are. So if you're going to plan for this, when's the best time to start? Today. I mean, today is absolutely the best time to start planning for this. Number 2, Roth conversions. Pros and cons of Roth conversions.
I think the pros are this is one of the lowest tax brackets we've been in as a country. So that's a pro if you can stay within, somewhere in the 24% or less tax bracket. Most likely could be a good solution. Obviously, we don't know your stuff, but huge thing there. The fact is the compounding. If you can compound tax free and you don't have a required minimum distribution to take, so you only take what you need, not what is required of you, you may even leave a bigger legacy by not having to take more than you need and pay Uncle Sam his fair share.
And then your kids get a hold on to it for 10 years, and it can continue to grow tax-free over those 10 years. Not bad. Might not be best, but it's definitely not bad.
Lesser of evils.
All right. So to get those Roth distributions, right, to get them tax-free, essentially it's 59 and a half, or you've held it for at least 5 years and turning 59 and a half, right? That's really what you're looking for there. Roth conversions. Okay, who can do them? Anyone can do them. It's not like Roth contributions where there's phase out limits and stuff like that. Anybody can do a Roth conversion. You do not need to have income to do a Roth conversion either. Okay. The thing that some people get tripped up on with Roth conversions is that they think that I can do a Roth conversion, but I can do a backsies on it, to use the technical expression. There used to be something called recharacterization that you can do where you made a mistake. You converted too much. You want to go back and fix it. Or you didn't realize when you did it, you just heard it was a good idea. And then you're like, here's the tax bill, right? It used to be that you could fix it. You can't fix it. Once you do the conversion, it's done. Conversions also have to happen in the calendar year. Okay. The tax year, for as a lot of you on this call know, the tax year allows you to do things like make your qualified contributions to a lot of different stuff all the way up until the time you file your taxes, right? Conversions got to happen in the calendar year. It doesn't matter if you knew you were going to do it and you did it on January 1st. Too bad. That is the next calendar year. That's the year's income tax return that it's going to go on, and you can't recharacterize it. You're stuck. Okay. So best time to plan for this. And you can see there's a whole bunch of, whole bunch of features with Ross. I know I'm talking a lot here, but the idea is get the money in, be thoughtful about when you do it. Ideally, September, October, November is when is the right time to sit down and start really thinking through how much am I going to convert this year. Ken and Jason, I know you guys have a little bit different perspective on this. When's the absolute latest somebody should talk to us about doing a Roth conversion?
As soon as possible. I mean, there's so many factors involved in that Roth conversion, especially looking at your 1040. January 1, if you think you're going to do it in 2025, that's when you should talk to us.
Yeah, absolutely. Absolutely. As soon as possible. As soon as possible. So I talked about this already, eliminating recharacterizations. You are stuck with the conversion. Okay. But here's the three key questions that you have. Now, Ken, I'm going to ask you this. When you're looking at these three questions, how do you have this conversation with your clients?
So it really starts with how they feel about taxes, where the breakdown of their assets are, kind of going through what ifs is, okay, if a $20,000 expense comes up, whether it's for an emergency, an RV, or helping a kid with college, where are these dollars going to come from? And then just going through that what if chart and talking about what those implications might be. And so depending on where you're at, what you're wanting to do, and your relationship with taxes, and really understanding the consequences is kind of how that conversation goes. And more times than not, it leads to some form of a Roth conversion. It's just how much is ultimately what we're going to do.
And I would add to that, it's pretty critical to know where you're going to pay the taxes from. Because if you have to pay it from the conversion asset that you're using, like the IRA, then your compounding is severely impacted and you're really not getting a full Monty of what you would get paying it from an outside account, a bank account, brokerage account that you have after tax money in.
Right. Right. So we hinted at this earlier with the progressive tax system, right? But what a lot of people will do is they'll take a filling up the bracket approach. And that's basically, I want to stay in the same income tax bracket, but I want to convert as much as I can. That's a great strategy. The one thing I'd say is just remember it's a progressive tax system, which means not every last dollar is going to get taxed at 24% if you end up in the 24% bracket or the 32 or the 35. It's just the dollars that are over that amount that get taxed at that rate. You still want to be thoughtful, right? Because there's a bunch of other ripple effects of doing the conversion. But just keep in mind, if you're focused exclusively on this idea of filling up the bracket, my suggestion would be just open up the blinders a little bit to take a broader look at what the impact really is. Because you might not have, your kids might be done with college, like Ken was talking about earlier. Mortgage is paid off, all this other stuff. You have disposable income. Like Jason said, you might have money sitting around where you can actually just pay the taxes on the conversion. Well, what's stopping you at that point? I don't know, right? I don't know what would be stopping you at that point. So one of the things we see people do is low income years. So you can see some of the different ideas here. There's the business owner. I'm having an off sales year, right? Or I'm in a cash flow type of business and I'm having just a depressed income year. That might be a good year to do it. Maybe I had a ton of expenses. I'm in startup mode, right? I'm year one or year two. I'm in that passion, new business that I always wanted to do and I'm ready to go. That might be a good time to do it as well. High non-recurring medical bills. If you haven't, you're going to see us do a lot on long-term care and Medicare later in this summer. If you haven't thought about medical expenses in retirement, you absolutely need to be thinking about medical expenses in retirement. Not just your Medicare premiums, but also how are you going to fund and manage a long-term care plan for yourself and your spouse. You need to be thinking about that. High medical bills do come with tax deductions generally, but you want to make sure you're in a position where you have good options when something happens. You don't just want to have one option because now you're painted in a corner. The other thing I'll say, because all the income planning we do, we run into this a lot as well, is I'm 62, I'm retiring now, but I'm going to wait till 67 or 70 to take my Social Security. Well, hey, guess what? In that 5 to 7 year window, which is you might read it's referred to as the blackout period from a Social Security standpoint, where you're not taking income but you're retired. It might make sense as part of a Roth as part of a RMD management conversation to start drawing money out of those traditional IRAs to pay your expenses in your 60s to maximize the tax exempt nature of Social Security later on in life. It might make sense. The reason I'm saying might, everybody's situation is a little different. So you always got to make sure you sit down with me, Ken, Jason, ideally pull your tax professional into the conversation as well, because good planning a lot of times involves bringing in more than one expert to make sure you're getting a good result. All right. And let's see here. Okay, we've talked, I think, enough about Roth conversions. Moving money directly. Okay, there's the indirect rollover versus the direct rollover. Jason and Ken, do we generally recommend the indirect rollover for any reason? How come? You're both shaking your heads. How come?
It is a time bomb waiting to go off. Also, there's a required 20% withholding, which technically you can get back. But if you've ever corresponded with the IRS, it is one of the most difficult things and processes. It's yes.
Yeah.
So if you're okay giving up 20% and never recouping that 20% back, probably not wise to do the indirect rollover.
Jason, any additional thoughts?
It's just the payment. If you're gonna do indirect, just be prepared to spot that 20% when you send the money in, so you can have it at the actual amount that came out of the 401k. So if you've got an extra 20% of your 401k laying around in cash, to spot it, to get it to the amount it needs to be at, then great, you'll end up at the same spot. I tell you, 9 out of 10 people we meet aren't in a position that they can do that, especially with IRAs being at, or 401ks being north of 500 to $1 million plus.
All right, then let me ask you that. Those are both great points, guys. Let me ask you this too. So I did my indirect rollover. I'm really unhappy with the team I did the indirect rollover to. Now I want to do another one. Can I do it in the same calendar year? No, you can only do one during the calendar year. So there's indirect rollover. Direct rollover is much more straightforward. It is literally your 401k provider writes out the check, and I'll show you an example here. They write it out to the custodian, which is the company that will hold your funds for benefit of you, and then it will say IRA or Roth IRA. And you'll see here in the memo, it says direct rollover. A lot of times in the memo, the account number gets put in the memo, and it's the account number that the funds are going to, just to make sure there's no confusion when the money gets to the new custodian. So we get asked about what's a custodian. We get asked that a lot. One of the reasons we like to work with Kestra Financial is because we have Fidelity as our custodian in the background. And so from a planning standpoint, I don't want to say security, but from a security standpoint, right? It is a company that is a third party acting as the custodian. It adds credibility, I think, to everything we do, knowing that Fidelity's holding the funds on your behalf. We're not holding the funds on your behalf. Okay, coordinating the IRA planning. Now, this is where I'm going to kick this over to you guys. We've got a retirement plan. We have a estate plan. We have a tax plan. We might be doing some education planning. We have our overall financial plan. So when we're coordinating withdrawals from an IRA, coordinating Roth conversions, coordinating just paying an RMD, right? What are some of the big pitfalls people need to be looking out for when they're doing their coordination of this?
I'll start. I think one of the things they should be thinking about is what are their assets in their IRA versus the brokerage. Depending on if they have a brokerage account that's spitting out, maybe they have all their bonds in their brokerage account. Well, that's spitting out a lot of taxes on it, where their stocks might be in that same scenario, their stocks might be held in their IRA, and that's getting the growth. Oftentimes, depending on where your assets are, more of your bonds should probably actually be held within your IRA and more of your growth assets within the brokerage account. But again, that's just one of the things to be thinking about coordinating is looking at your overall asset allocation and what falls where.
So Ken, what you're getting at is the idea of take advantage of the capital gain system versus the income tax system, right?
Absolutely.
So Jason, what do you think? Or what are some of the pitfalls you see?
One of the biggest pitfalls I see is for people over 65 is the IRMA.
So Medicare planning.
Yeah, Medicare planning, because you don't, you're doing your Roth conversion. Yay, I'm saving money, long-term taxes. I've saved hundreds of thousands of dollars. And then 2 years later, you get a surprise. And it says, hey, by the way, you're spending $800 a month on Social Security. We had one client that was spending, between him and his spouse, $1,000 a month on Social Security. He wasn't expecting that. Now,
Yeah. Yeah, you mean Medicare, right?
yeah, excuse me, on the Medicare.
Yeah,
that comes out of his Social Security, right?
Yeah,
Because he
yeah,
sees it extracted.
yeah.
But he's like, wow, where did that part B of $500 each come from on me and my spouse?
So folks, where we saw those two kind of come together in kind of an ugly way was really, I would say, the end of 2018. So a lot of people don't remember this because it's pre-COVID, right? In 2018, the first trade war started, right? And it died down pretty quickly. But 2018 was a positive year until December. And then it turned negative, right? And then there was a ton of trading that occurred in December in mutual funds, portfolio managers in general, because what were they trying to do in the last month of the year? They were trying to minimize losses, right? I mean, that's what they were trying to do. Best intention, right? So you come back from your holiday break, right? You've had an awesome time with your family. You get your Q4 and end of year statement, and you're like, what happened? Everything was looking great on November 30th, and now I got a loss. And then you get your 1099s about 2 or 3 weeks later, and you see you have a $5 or $6 or $7,000 capital gain that you're going to be responsible for paying, or 50 or 60 or $70,000 in capital gains that you're going to be responsible for paying, right? So what Ken and Jason are getting at with this is have the right assets in the right spot, but also make sure that if there's going to be something unexpected happening, that you can pull it from the right spot, or you can minimize the impact of it when that unexpected event occurs. So that's what this gets into. Here's just a quick example for you. You have 100 in an IRA, you have 100 in a non-IRA, you're in the 24% tax bracket. And you want, this is basically what Ken was getting at, right? You want to have 4% a year. You want to have, $8,000 a year coming out of the two accounts. Well, okay. If I'm taking money out of stocks paying qualified dividends, I have a $960 tax bill, right? Total tax bill, $1,920. Okay. Straightforward. Bonds tax at the same rate. However, flip it around, just like what Ken was talking about. Look at the difference. Maybe your situation is one where you add 1, 2, or 3 zeros onto that. If that's the case, would you rather pay this number, the 1920 at the bottom of the page here, or would you rather pay this number, the 1560? I know you don't want to pay either one, but which one would you rather pay? You'd probably rather pay the smaller one.
It's basically 20% of savings and taxes.
Yes.
And then you multiply that by every year that you do it, it gets pretty big.
It gets added to your overall return, right? So if anyone hears the expression tax alpha, a lot of times that's what they're talking about is how does the tax strategy affect the overall performance of the portfolio? Because does the IRS care if the market tanks in the first quarter of the next year while you're getting ready to pay your taxes? Absolutely not. The IRS does not care. You still got to pay it. Okay. No guarantee, of course, that things are going to perform the way we showed in the chart, right? Not all dividends qualify for long-term capital gains rates, so you got to make sure you're getting the right stuff, right? And there's no guarantee that tax rates won't change either, of course. Social Security coordination. We pretty much talked on this about this earlier. I'm gonna kind of go through this a little quickly. but essentially it's the idea of wait to take Social Security because Social Security, at least a portion of it, is always going to be tax exempt. So if you're trying to build up that tax exempt income for yourself, why not take money out of your IRA in your 60s and let that tax exempt income grow as much as possible? Um, Estate planning. Now this is Jason's jam by far. As much as he loves tax planning, I think he loves estate planning even more. So, Jason, what I want to do here, and we're coming up at 52, so we're going to try to wrap up in the next 5 minutes or so, which means we do not have time to do this, proper justice. Can you talk about just some of the, designated versus non-designated and eligible beneficiaries, right? Can you just talk through what does that mean for the beneficiary?
Yeah, definitely. An eligible beneficiary, think of it as your spouse, someone that's in a 10-year window of you. They're considered of your same age, right? Even a spouse that's not within a 10-year window is considered of your same age bracket, which means that they'll get to continue on with the IRA, take the distributions over time, right? Over their lifetime. It becomes when you're trying to pass that asset to someone like a child, right? Which a lot of people tend to do because their asset's so large, is that they don't consider them an eligible designated beneficiary. They're actually a non-eligible designated beneficiary, which means according to the Secure Act 2.0, hey, you've got 10 years to get that thing out. And based off of um, current notices that they've given, you actually have to take a little bit out in those 10 years. So you can't just go zero and take it all out in 10. You do have to take a little bit in at 1 through 9. So it really speeds up. If you think about it from a tax perspective, I have clients that inherited IRAs in 2019, 2018. They get to stretch those things for 47 years. That's a lot of compounding over that period of time, as opposed to 10 years, which is pretty quick exit and a lot of tax that the government's going to collect. The second part is thinking about your estate. Some people have to uh, position these things to non-designated beneficiaries that's in their estate. So if you send it to a charity, great. No one cares. The charity's tax exempt. They're not going to pay any taxes. Perfect. Dollar for dollar, they're going to get every nickel that you give them. It's the best of all worlds from that end. There's also trust. Some people have situations where they need to put that money in trust, so the person doesn't use the money for maybe things that could be harmful to them, right? Not all situations are great situations, and sometimes people have beneficiaries that could endanger themselves with drugs or whatever it would be to harm themselves, and they have to have a trust in there to kind of keep that going. It's hugely important to understand the codicils of that trust. And is it an accumulation trust? Is it a conduit trust? How is that trust set up? And will it allow you to follow laws that say, hey, I can do it over 10 years? Because most trusts, you have to liquidate them in 5 years when you give them a retirement asset.
Yeah, and the one thing I'd say too is, and thank you, Jason. Well, the one thing I'd say too is, and you'll see I'm going through a lot of this, that if you are the recipient of one of those old stretch IRAs, right, from what was it, pre-18, pre-19?
19.
Yeah. What we used to do, and you still can, so you're going to want to talk to us about this. There was an insurance strategy that we used to talk about all the time with people with the stretch IRA, which was basically if you don't need those stretch dollars, how do you turn that into a big legacy for the generations coming behind you? And that can be a really, really effective way of maximizing the impact of those dollars you're receiving from your parents who maybe have been gone for quite a while at this point. So it's one thing to think about. Jason talked briefly on trust. We're going to keep moving because we are really in the we want to be respectful of everyone's time. One thing I do want to talk about, Jason and Ken, is when the spouse dies, right? What happens, right? Because IRA stands for individual retirement account, right? So what happens when the spouse dies?
They really get a choice. There's two paths. There's you can take over the spouse's IRA and roll it into your IRA, or you can set it up as an inherited IRA. I had one client do that many, many moons ago. She wasn't of age, meaning she wasn't 59 and a half, and she had to inherit the IRA so she could take distribution.
And that's the remain as beneficiary option, right?
Yep.
Yeah. Yeah. So you've got options when your spouse passes in terms of what do you want to do. Okay. Um, Watch out for scams. Okay. There's a lot of information out there about a lot of people right now, and there will be going, forever, right? Watch out for scams. If it sounds too good to be true, it is. That's the only thing I can say is just watch out. If someone has some great IRA tax mitigation strategy that you've never heard of, get a second opinion. I mean, at least get a second opinion before you make any decisions. We can help with that. So from a next step standpoint, we had a lot of people on today's call. You're all going to get a call from us today just to say thank you for attending. And if you work with Ken mostly, you'll get a call from Ken. If you work with Jason mostly, you get a call from Jason. If you work with me, same thing. But we are here to help you answer those questions. We're here to help you put in place the right strategy. What I'm going to ask everybody to do when you get that call from us is not just be prepared to have a conversation with us, but I want you to I want you to take a minute right now, write down the names of 3 or 4 people you know who are wondering about this stuff. Because if you're wondering about it, so is your best friend, so is your sibling, so is your favorite cousin, so is a coworker that you have a great relationship with, right? If you're wondering about these things, so are they. And Ken, Jason, and I will make a point of asking you, hey, whose names did you write down and how would you like to introduce us to them? Because it's your friendship and we never want to get in the way of that. We never want to get in the middle of that. But they have the same questions you do. They absolutely do. And that's why you were here today. So do them a favor by making sure you introduce them to us when we make that quick phone call. And again, feel free to reach out if you do have questions. If we end up trading voicemails, we did record this session today. It will hopefully by the end of the day be on our YouTube channel. You'll see a follow-up email come out tomorrow with the link to it so you can share that recording. While we're talking YouTube, go to our YouTube channel. Just go to YouTube, look up Mission Financial Planners, subscribe. You'll see that's where the video version of all of our weekly updates are. And there's a ton of financial education out there for free that you can just take a look at, you can view, you can tell your friends and family about. We don't firewall it. We don't charge a subscription fee for it, anything like that. But go ahead, check that out. It's YouTube Mission Financial Planners is what you want to look up. So we're at 59. Jason, 10 seconds. What's the number one takeaway someone should have from this?
Number one takeaway is if you don't plan for what your taxes should look like, the IRS has a plan for you.
Ooh, ouch.
And it's not in your favor.
Ouch. That's a great one. Okay. Ken, 10 seconds. What's your takeaway?
Look at all your dials, really understand where you're at, what's balanced, what's out of balance, and land the plane.
Got it. My big takeaway, folks, do it. Sometimes that's the hardest thing is to take the first step, but do it. Okay. Thanks again, everyone. We will be in touch later today. But if you do have any questions in the meantime, feel free to reach out proactively as well. I know you all have Ken's, Jason, and my direct numbers. You can see the toll-free number for the office on the screen in front of you. Thank you again for your time. We're right at the top of the hour. Have a great rest of your day. Thanks, everyone.
Okay.